Look, it ultimately, of course, it is an income strategy, hence cash flow on demand, generate cash flow on demand. Pretty eponymous when you think about it in that respect. And, it's a three-step strategy. You've got to have an asset to generate income, whether, as I say, it's a property or whether it's a portfolio of shares that are paying a dividend. And I guess the challenge with, shares that pay a dividend, they only pay it twice a year. Most people have got bills that come along far more often than that. So having a cash flow that's more regular and unlike a dividend, which you typically see the share price drop on the back of it being paid, this is because you're moving income from your left pocket to your right pocket. Basically, it's gone from the capital account to the income account. This is a pure, genuine creation of income strategy, which is again why I like it. So regular income paid weekly, fortnightly, monthly, however you want to run with the thing, is something that's very, very appealing. So the three steps to it, really simple. You buy an asset, you generate income off that asset, and then ultimately we wrap our own particular, secret sauce around that when it comes to risk management to make sure that if things go wrong, when things go wrong, because we live in an economy and an environment that can change quite quickly, you've got the ability to protect that downside to give you peace of mind. Hey guys, welcome to this week's Money and Investing Show. This week we're going to lift the bonnet on cash flow on demand. This has been our flagship strategy now for almost 25 years. There's some nuances to take out of this in terms of what's involved with a good quality trade. More importantly, some of the benefits of this particular strategy. As always, make sure you take notes, but most importantly, make sure you take plenty of action. Hey guys, welcome to this week's Money and Investing Show with me, your host, Andrew Baxter, and as always, my offsider and co-host, Mitchell Olarenshaw.
Hey B, good to be here. Now, I'm not sure how you're going to go with this one because this is a strategy you've probably never done a million times in the past before. It's our all-time favorite flagship strategy, the beauty that it is, and that is cash flow on demand. Let's get into a deep dive on that.
Indeed. Look, it's a strategy I've been around for a long time, and there's a reason why, and it's because it ticks so many boxes for investors, that's for sure.
Yeah, this is our flagship strategy at Australian Investment Education. I've had a couple of questions come through on our podcasts, just as we've been talking about certain strategies that we're running, saying, hey, what's this? Can you explain it a little more? So we've heard the people are listening. Let's talk about the strategy, what it is, how it works, and why they should do it.
All right. Well, I guess if I sort of think about how this came about for me, I was running a broking business, and one of the biggest challenges with any kind of broking business is it can be a leaky bathtub. You have clients come in, clients go out, and the idea would be that you want to put a plug in so your client and business effectively grows, which got me looking at education, because at the end of the day, education is the best investment you'll ever make. If you've got clients that understand how to manage risk, understand what they're doing, they're very easy to work with in the first instance, purely selfish motivation for wanting clients like that. But secondly, they don't make mistakes, they last a long time. And so that's good for everybody. So that was kind of at the back of my mind. And then, you look at the notion of the great Australian dream of owning a home, renting it out. It's a time-tested investment strategy for so many people, yet it's not affordable for that many people. 20% deposit in a property market, especially today, of course, that's relatively expensive. So how can we get the benefits of some asset appreciation, great income, but also manage risk at the same time? And that's really how this strategy came about for me. And that was probably almost 25 years ago since I've been in Australia. It's been where I've really sort of hung my colours to the flag and got on with it. So.
Indeed. And I know there's a few different flavours and spices we've been able to add to that strategy in the last few years as well. So
it's evolved massively. It always does. Like anything good, the foundations are firm. But there's also evolution in that process too.
That's right. So cash flow on demand as a strategy, I mean, the name does give it away to a small degree, but what's it all about? What are we doing?
Look, it ultimately, of course, it is an income strategy, hence cash flow on demand, generate cash flow on demand. Pretty eponymous when you think about it in that respect. And, it's a three-step strategy. You've got to have an asset to generate income, whether, as I say, it's a property or whether it's a portfolio of shares that are paying a dividend. And I guess the challenge with, shares that pay a dividend, they only pay it twice a year. Most people have got bills that come along far more often than that. So having a cash flow that's more regular and unlike a dividend, which you typically see the share price drop on the back of it being paid, this is because you're moving income from your left pocket to your right pocket. Basically, it's gone from the capital account to the income account. This is a pure, genuine creation of income strategy, which is again why I like it. So regular income paid weekly, fortnightly, monthly, however you want to run with the thing, is something that's very, very appealing. So, the three steps to it, really simple. You buy an asset, you generate income off that asset, and then ultimately we wrap our own particular, secret sauce around that when it comes to risk management to make sure that if things go wrong, when things go wrong, because we live in an economy and an environment that can change quite quickly, you've got the ability to protect that downside to give you peace of mind. So they're the three headlines, I suppose, as to what's in the guts of that strategy. And I know, as you say, we've evolved this considerably over the last few years to offer more and more benefits to our investors. But they're the core three: asset, income, and risk management.
Let's give our listeners a bit of a sneak peek. Any of our existing clients will know this strategy inside out, but for our non-clients right now, so you talk about buying the asset first and foremost. What does that entail exactly? How do you do that?
Sure. So what we do, we buy an underlying asset, usually shares. It can be exchange-traded funds too, to run this strategy. We buy them in packets of 100. And there's a reason why it's 100. It's a standardized amount because very shortly we're going to introduce something called an option, which is a derivative, part of the derivatives family, and they require standardization. So the asset you're going to buy is 100, 200, 300, 1,000, 1,100 shares, whatever it may be in terms of the quantity to suit your budget of a particular type of asset. Let's take Commonwealth Bank as an example of that, or the Nasdaq. If you wanted to have a very diversified underlying instrument using an ETF, would be what you buy.
So you're buying an asset to do so, and this is a lot of what I do day to day with my guys on the trading desk is the analysis. So we talk about technicals, quants, and fundamentals. Yep. How do we break each of those three down?
So technicals and fundamentals, if you've ever opened or looked at a stock chart, you've got an idea of what technical analysis is all about. And unfortunately, it's an area I see a lot of people can become devotees to. All the answers you need are in the chart. That's simply not true. Try explaining September 11 without knowing that there'd been a terrorist attack. The chart in itself didn't tell you the answer. But the charts can be very, very handy for timing. And timing, of course, is massively important when it comes to active investing. So looking at areas that are relatively cheap to buy stock, oversold, or overbought when the share price has moved up, probably as high or higher than it should be, are important market points to have in your trading arsenal. So using the charts to help you with the timing is key. The fundamentals, I guess, give you the news flow as to why things are moving in a particular way. So let's say there was an act of terrorism or conflict in the Middle East. Fundamentally, you'd expect to see oil prices move higher because there's the risk of disruption to supply, and the world relies on oil. And so you typically would see oil prices move higher. So if there's a piece of fundamental news pointing toward trouble in the Middle East, then fundamentally you'd expect oil prices to be higher. You can look at the chart to help confirm that. And that's going to give you two of the three boxes ticked, I suppose, in terms of, okay, let's get some exposure to the oil sector.
Well, it's funny you say that. We've just, and I mean, this obviously pains me to say, but between Iran and Israel, we've seen some conflicts and pretty violent conflict at that. We actually had a position running on oil prices using an exchange-traded fund called USO, which has just come really, really good and very profitable for our traders. So there's a real trade example that exists right now.
Yeah, and if you want to look at, say, something on the other side of the equation, if you think about when we had the pandemic, air travel stopped, so airlines probably were not the best thing to invest in. Equally, hotels fairly unlikely to be inhabited when everyone's in lockdown. So fundamentals give you the reason why. So if you think about the technicals, tell you when, fundamentals why. The last part of the equation that we like to use is something called quants. And the reason, I guess, we developed that third part of the analysis is that not all stocks are the same. Investors are quite different. Some people are quite aggressive in terms of their attitude towards risk. Other people are more conservative. And choosing stocks or underlying assets which match that personality type gives you the ability to be in investments that are suitable for you. So, if you're a very conservative investor, being exposed to a geared exposure towards the Nasdaq, for example, that's typically very volatile, isn't the place you should be investing. That doesn't mean the stock market's not bad. It's just you're in the wrong part of the stock market. You should be in something that's a little slower moving, that's more suited to your particular investment personality. And quants and the proprietary way that we use them through volatility helps us ensure that clients know which part of the market they should be in based on either their experience level and or what their overall attitude to risk is. And they can make that decision for themselves. There's not a requirement to provide personalized advice because whether you're someone that's reasonably conservative or not, and we'll teach you how to find stocks that match that criteria, so you can let a lot go through to the keeper that's not appropriate for you.
Indeed. It's quite nifty, isn't it? You're picking stocks that suit you, figuring out the right time to get into them and why you're getting into them. I mean, that wraps it around.
It does. And look, there's a lot of detail within each of those 3 steps, of course there is. But they're the sort of headlines as to how we build a business plan, if you will, to help select assets that give us what we need. So that's part 1 of the equation, the asset taken care of. Technicals, fundamentals, quants help us choose which assets right.
Well, part 2 is the income component, which probably a lot of our listeners right now are most interested in. So how do you, without dividends, generate income from the stock market?
So we use options to assist us in that space. And I guess options are probably one of the most widely misunderstood financial instruments that are out there. And a lot of people, they're really risky. And when people say that to me, I kind of, it reinforces why we do what we do and what we've been doing for the last 25 years, and that's educating people. And it's like anything. Some things are very dangerous and you're to stay away from them. And if you get educated and understand why to stay away from them, that's a good thing. It stops curiosity pulling you into that sort of lane of bad outcome that's going to come and get you. Options, when they're used correctly, are designed for mitigating risk, and they're designed for creating income. And if you use them in the correct fashion, even the ASX in themselves will tell you that this type of strategy is lower risk than owning shares. Yet I hear from time to time, I spoke to my accountant, he says things are really risky. Usually when someone tells me that, I usually say, here's a link for our training, get your accountant to come along so that they can actually find out what they're talking about rather than shoot from the hip. Because when they're used correctly in the way that we do with Cashflow on Demand, it's a way of reducing risk on your portfolio, not actually adding to it. And that's directly from the ASX. That's not me saying this. That is their view on this. So
it's a hedging strategy, right?
Correct. And so selling an option gives you the ability to create income. It's like selling anything. If I sold you a pen, I'm going to get some income back. And so selling an option gives the ability to create that income. And the great thing about this is that you can do it regularly. It's not like a dividend that's twice a year. It's something you can do monthly. It's something you can do fortnightly, weekly. With some of the trading that we do, we run this system on a weekly basis for generating income. So it's kind of like, very crudely, and I'm not saying, and I know the regulator don't particularly like this type of explanation. If you can imagine, if you've got a house, that's your asset, and then the tenant pays you rent each week. With our strategy, instead of buying a house, we're buying a packet of shares in blocks of 100. That's our asset. And the income we're getting isn't really rent. It's actually the income from selling an option in a similar type of way to get that regular cash flow coming in the door.
Very nice. And look, we work to some parameters on that, of course. It's not just any option. There's a specific time frame that we use.
There are a lot of nuances. I mean, your guys and the value add that you bring with your analysis is the secret sauce that make this work. It's not something you're just going to walk up and start doing this. And I would highly discourage anybody from just walking up and starting to get educated first.
100%. What about the last part, managing the risk? That's probably where most people feel, I guess, probably a little bit fearful.
Everyone, and again, some of the sort of feedback you get from people sometimes, I've spoken to someone, or my advisor or my accountant said this, and it's just a baseless drivel that they've been told, and it's negligent on the part of the person that's actually made that claim. Managing risk is key. It doesn't matter how much money you make, it's how much you get to keep ultimately at the end of the day, which is crucial. And having good quality risk management, which comes in many, many shapes and forms. It can sometimes be by having a diversified portfolio to reduce your risk. It can be about spreading market timing, so you're not putting all your assets in the market at the same time, which could be at a high or a low or somewhere in between. So that dollar cost averaging of buying in is a very, very useful tool. But having things like a stop loss, which is effectively, if the trade goes against you, you close out of it. And a lot of people would scratch their head over that going, but why would you want to close and lock in a loss? And the answer is really simple. And I say this based on nearly 35 years in the market. All big losses used to be small ones.
Oh, that's a good comment, that one. I like that.
And if you've got the ability, if it's starting to go wrong, to get out early, you can always buy back in later. It's as simple as that. So on its most basic level, that's one of the 4 risk management tools we use. We also can use a form of portfolio protection or insurance, again, going to the options market, using put options to not only protect capital, but also to protect profit, to give people a guaranteed profitable outcome, is the sort of work that you can do. That's not to say every trade is guaranteed. Let's be really clear, because I'm sure there's going to be a keyboard warrior that's got something to say about that. The reality is that you can strategically apply risk management to lock in and guarantee your gains out of a trade. And if you're not sure about that, come through our training. We will explain exactly how you can do that. Very, very important, because that we are in an uncertain world. And if you've been in a market that's moved up very, very strongly, which we saw through 2024 and starts to look toppy, you don't want to give all that profit away. And for taking a little bit of time to get educated and applying some more professional skills, is why professionals get paid, amateurs don't, of course. Applying some more professional skills gives you the ability to have peace of mind and protection in your portfolio. Not
100%.
sure what any of that is. Come through our training. We explain it all in glorious detail, not just two of us having a yak in a room here.
That's right. You don't know what you don't know, and there's a whole different world out there when you talk about this.
You've got to be
kind
open
of
though,
thing.
Mitch. Some people are going to have their arms folded. I know everything. If you already know everything, you don't need to listen to this. Go and enjoy your life and the tens of millions you've already made from everything that you already know. You've got to be open. You've got to be open, because money only flows to people that are open and people that are teachable. And in today's market that's shifted and is maybe a little bit more fickle right now, having these skills at your disposal is key.
So a question for you. You mentioned before you can do this on individual shares, but also exchange traded funds. So let's take a case study. Let's say someone's working with 50 grand in cash to work with. What would a model cash flow on demand portfolio look like?
Look, you could cut that cake up a number of different ways. It comes down to what the risk appetite, for example, is of the client. Yeah, one way in a more traditional sense would be, okay, you've got 50 grand, buy 5 different shares, 10 grand a pop, and you've got a reasonably, not 5 banks, obviously, but you've got the ability to diversify yourself a little bit there, which is a great way to do it. And you can create income on each of those assets as you move through, which again is very, very attractive. The alternate to that is, if you wanted to have a more diversified and more passive portfolio, you could simply buy a couple of ETFs. So you might go, look, I'd like to track the US market, the NASDAQ, and you could go into the Triple Q ETF, which is the top 100 stocks in the NASDAQ. So you've now got 100 shares in that portfolio, giving you the benefit of great diversification. It's a great opportunity to create income from that particular asset class, because you can sell options each week, each fortnight, each month over that particular ETF, and you've got a nice diversified portfolio. You might want to have part of it in a US ETF and part of it in some Aussie stocks. You might want to have, say, CBA or BHP or whatever it might be that floats your boat on the stock side of things. And then the balance of it over in an index tracker to give you, again, a slightly different flavor. So this is why education is so important. There'll be other people that come in that just say, look, I'm 25, I've been working in the mines, I've got 50 grand saved up, I do want to get into property, I don't have enough cash for it right now, I don't like crypto because it's unregulated and is a bit of a wild beast for me. Put me into a geared ETF that's nice and spicy, that has the ability to create great, like really solid income on a weekly basis, even to help compound that 50 grand up to 100 or beyond. So I can then start to move into the next phase of my life, which might be another property or whatever it may be. So it comes down to where people are coming from and really what they're looking for. There's no one size fits all. The one consistency with this is it's exactly the same strategy: asset, income, and risk management. But the nuances that go into choosing the right asset, the right risk management, and the right income will vary depending on the appetite of the client and the time of trade we're moving in. And that's the nuanced stuff that we cover.
100% well said. And we look at, as we get to the back end of our episode here, some client success stories who have literally started from this strategy. I take some of our traders of the year, our nominees, who probably don't know that they're nominees just yet. But we take, say, for example, Jason down in Melbourne. He was a developer who then switched into the stock market running cash flow on demand. What were some of his results?
Look, I mean, he had a great run, $205,000, I think, $1,000 for
202, maybe somewhere in that range.
So around $200,000 worth of profit for the year. As a percentage, that was about 25,
something along those lines.
25% for the year, against a market, of course, where if you think about I think last year the average return from the superannuation industry was 11.4% for 2024.
Right. Yeah,
so more than double what that is. And there'll be the naysayers going, keep your money in industry super and do all that. You've got to, if you want a different outcome, if you want to get somewhere, you have to look at different things. Get educated on it first so you can find out how to do this. And bear in mind, this isn't just in your super. You can do this outside of super, create great income all the while along the same sort of lines. So that was Jason. If we take, for example, Tony, one of the great guys, we've worked with Tony on and off for quite some time now here on the Gold Coast. A really significant percentage return on his money. So his percentage for the 12 months through to 24 was...
I can't remember exactly, but I know he did well. I think it was around 28, 29%.
Yeah.
which, for someone trading primarily the US stock market was a clear outperformance. Once again, also in his super as well. So certainly outperformed the average super fund.
I think it was about 55 grand or so it made, which for him was just great cash flows, $1,000 a week. And if you're listening to this, what could you do with an extra grand a week? And it's just using this strategy, working the process. And this is what it's all about. This is about everyday people. This isn't a strategy for the big end of town or for the novice. It's actually a strategy for anybody that's open-minded, that's prepared to get educated and is focused on what they want as an outcome. And the outcome is, if you want your money working in a strategy that's got the ability to create more income, which is demonstrably able to outperform the market. And I'm not talking about just those 2 client case studies. Again, there's a whole bunch of research that comes out of the ASX to support that statement, where it is a strategy that does outperform over the long term and is lower risk. What's not to like? Maybe us, actually. I won't say that personally. If you don't like us, that's cool. I don't need to be liked by people. But what I want to do is help you get your money working. And that comes down to you and the decisions you make to get educated and then to follow the education you're provided with to make it happen.
More money, less risk. It makes sense. So my final question for you then, AB, if you're someone who's listening.
When you put it like that, I mean, it sounds almost...
More money, less risk, right?
Yeah, no, not possible. My map of the world is such that the only way to make more money is take more risk. Get educated, get out of that box that you've put yourself in, that self-imposed financial cell, open the door before you risk a dollar, go and get educated, find out how this stuff works for real, and you'll be blown away where it can take you. But if you're not open-minded, keep that box shut, stay away from our ecosystem. We don't need people like you coming through to jag it.
That's right. And if you don't believe us, go and look at the ASX website. Compare the buy right index to that of the ASX 200 over the past 20 years.
Yeah.
See for yourself.
Significant outperformance, but hey, that's there.
Where do you get involved in this kind of information? For anyone listening to this thinking, yeah, that kind of sounds like me, what do you suggest?
Look, come through, check out one of our training sessions. For 25 years now, I've been at the forefront of investor education. We're teaching people this stuff in a non-jargon way. Paint by numbers is key. And we've got so many ways our clients can engage with us now. It does start with education. You've got to learn a little bit about what this is. But if you want us to do this for you or do it with you, or if you want to learn how to do this yourself, we can accommodate a solution that works for you. And obviously that depends on how deep they engage with you and your team on the other side of it. But it just starts by opening the door, seeing how it actually works, come through that free training session. You have nothing to lose. You're going to come along, see what we do. It runs for about 90 minutes. It's free of charge. If our circles overlap and what we're talking about resonates with you, you can have a chat with our team and see where we go from there. And if it doesn't resonate with you, that's okay too, because it's one less distraction before you go focus on a different type of investing. There's no downside to it at all.
Indeed. Well said, AB. Thank you very much.
Absolute pleasure. Anytime, Mitch. There you have it, guys. Make sure you like, comment, subscribe. Most importantly, hit the notification button. If you've got questions for us, hit up the Ask Andrew button that's in the body text below, and we'd look forward to answering those questions from you in our next podcast. See you next week.